We also, in addition to doing drilling funds, we have oil and gas mineral funds where that puts the investor in the position of a landowner. So, when you're buying minerals, you're buying part of the landowner's interest. There's not really a lot of tax deductions, IDC deductions on buying minerals. It's more of a long-term hold. But the key to buying minerals is that you have to be in an area where there's going to be multiple wells drilled, and you got to have multiple layers in the cake in order to make a nice return. My name is Michael Mauceli, and this is the Energy Show with REI Energy, where we're energizing your investments and maximizing your tax deductions. Today we have a special show. A lot of times I have people ask me, how do you go about investing in oil and gas, and what are the tax advantages? Well, recently I gave a presentation to a live audience about oil and gas. I've decided to release the presentation to all of you who watch the podcast. I hope you enjoy it. Anyway, my name is Michael Mauceli, and I'm the CEO of REI Energy. And I've been in the oil and gas business probably, about 35 years. I started in the business in 1976 and basically worked for a company called Tennessee Gas, moved to Dallas in 1980, started my first company in 1987. Okay, well first, what would a world look like without oil and gas? We use about 100 million barrels of oil a day worldwide. We have over 8 billion people in the world to date. In the United States alone, we use over 23 million barrels of oil a day. So we use a tremendous amount of oil and gas. We make over 6,000 different products out of oil and gas. Just about everything we feel, touch, our clothes, the carpet in the room, all of it comes from some type of fossil fuels. So today we're going to talk about how do we mitigate risk, right? That's one of the main things in any type of investment. When someone goes into an investment, what's first thing that comes to mind? What's my risk of losing money? And so I'm going to tell you today about how our company mitigates risk and in our partnerships. And then secondly, we're going to talk about taxes. Taxes are very important. The oil and gas industry, the federal government back in, I think it was 1913, decided that, hey, we like this smelly, greasy stuff. We need it for our economy. We need to make all these nice things that we have. So let's introduce some laws that basically will promote drilling in the United States, that would give investors an advantage to go out and to actually search for oil and gas. And then, of course, in the end, when we put up money, how do we make money, right? That's the bottom line. I'm putting my money up, I want to make sure I get a return. So I'm going to talk to you today about the different types of wells. So when I started in the business, the only way that you could only drill a vertical well. Reservoirs were pretty small. You either drilled a vertical well, or you drilled a slanted well, or basically you drilled a dry hole, right? Because back then it was kind of a poke and hope type situation. You could have all the geology in the world, you could have all the science in the world, and so, you just had to work the numbers, basically. So the thing in our business back then, you had to drill 10 wells in order to find one. Well, today we're going to talk about horizontal drilling in shale plays. Our business has been revolutionized by the discovery of the horizontal drilling in the shale plays. And in fact, you see most major companies today like Shale, Exxon, a lot of these companies have now come back to the United States. But the type of plays that they're not drilling vertical wells, they're not trying to find, these companies, they look for billion-barrel fields, right? The bottom line is using that much oil on a daily basis worldwide. So I'm going to talk to you about shale. So the best way for me to explain it to you is like taking a cake. You cut that cake in half and you see all the different layers. And today the shale layer is usually in most plays about 2 miles deep, and we drill a 2-mile lateral. So in essence, we're drilling a 20,000 foot well. And a 20,000 foot well in these areas, by the time you drill it and hydraulically fracture it, the cost of these wells are right at about $9 to $10 million a well. So they're not cheap. And, as far as drilling. So now let's talk about risk, when we drill these types of plays. Because as I said, there's risk in every type of investment. And not all shale plays are obviously commercial. So what we look at when we develop or our projects where we're going to go out and we're physically going to lease land, first we look at our risk. Our risk are how much oil and gas am I going to produce out of this well, and what is the price of oil? And then what is my operational cost? Same thing as in real estate. Obviously, you're looking at these types of risks when you go in. And of course, here, we want to be in the fairway of the play. So it's just like when you go out and you play golf. If you hit the ball out in the rough, you're still in the game. It's just chances of you winning are lower. Same principle in a shale play. I'm going to make a well every time I drill because this shale has it has oil and gas in it. But if I'm out of the fairway and I'm out on the edges, I may only make a well that produces 150,000 barrels of oil versus being in the fairway where I have the potential to make a well that'll produce over 1 million barrels of oil. So that's where you got to have a professional team. And we have our own team of geologists, which is a geologist is a person that studies the rock. He tells us where the right spots to be at. And then we have our reservoir engineer, we have a drilling engineer on staff, we have land people on staff. So the reservoir engineers tells us how much oil and gas that we potentially can make out of an individual well. And then of course our drilling engineer tells us how much the wells are going to cost. And then our land people, they go out and physically lease the land from the landowners. So obviously we want to put ourselves and our clients in the best position. So this is a shale play up in the northwestern part of Oklahoma, and this shale play covers roughly about 20 townships, and it's about 2 townships wide. A drilling unit is about 1,280 acres. So what they do is they put 2 640-acre tracts of land together, and they form a drilling unit. And in that drilling unit, you're going to have anywhere from 2 to 4 wells drilled in it, horizontal wells. So basically, they're going to drill a 2-mile vertical well on one end of the drilling unit, and they're going to drill a 2-mile lateral to the other end of the drilling unit. So as long as I'm in the fairway, so how we determine where the best spots are for us to drill is that we look at all of the producing wells surrounding us. The nice thing about areas like this, you have about 10 companies involved in this particular play. Up in the Bakken, there's probably 25 or 30, but there's already been a lot of wells drilled. So we already can look at individual wells and see where we want to start leasing. So for example, here we're going to look at 2 wells. We're going to look at one well on the east side of the field, which is the Upland Barber well, and then we're going to look at another well on the southeastern side of the field, which is the Mewburn Carl well. Now remember, we need about 150,000 barrels of oil just to get our money back on these types of wells. So obviously, we're looking to make wells that are going to produce a lot more than that. But the key behind horizontal wells is that you get some tremendous flush rates because you're opening up, as you saw in the video, a large section of rock under the ground. So a lot of these wells, they'll come in 1,400 barrels a day, 1,000 barrels a day. In this particular area, they make about 60% oil and about 40% natural gas. And but as you can see, we're looking at the Upland Barber well. The well's IP was 1,470 barrels a day, 2.3 million cubic feet of gas a day, and we need to make 150,000 barrels of oil just to get our money back. So because these wells have such high flush rates in the early days of production, this particular well made 100,000 barrels of oil in the first 75 days. Now, 100,000 barrels of oil gross at $70 a barrel is $7 million worth of revenue. And, the well costs are $9 to $10 million. So, and again, in 577 days, this well made 304,000 barrels of oil. So we're in the right area, right? I mean, this is what we're looking for. This is what our team looks for. And of course, we're projecting that this well is going to produce almost 755,000 barrels of oil and 5.2 billion cubic feet of natural gas, which is equivalent to over 1 million barrels of oil over the life of the well. So then we go across the field and we look at the Mewburn Carl well. This particular well came in at 1,066 barrels of oil a day and 4.5 million cubic feet of gas a day. It made that 150,000 barrels of oil in the first 365 days. In addition to that, it almost made 1 billion cubic feet of natural gas. And again, it's projected to do 736,000 barrels of oil and 5.7 BCF of gas. So now we've got our area. Now we go out and we send our land people out and we start leasing property. So now we've got our area. We know what the risks are. We know how much oil and gas we've got to produce out of a well. So now let's talk about taxes. Because as we said a little bit earlier, the federal government, oil and gas, has some tremendous tax advantages. And of course, one of the biggest tax advantages that we have is what's called the intangible drilling cost deductions, or IDCs. Now, when you're drilling an oil and gas well, about 80% of the cost of the well, this $9 or $10 million, depending on the lateral length, is intangibles. And that's all, just exactly what it says. I mean, stuff that is not tangible. And then, of course, our next biggest tax deduction that we get is our depletion allowance. So the federal government, they came out and they said, well, we've got to have more of this oil, so let's put these incentives out there. And so we're going to, I tell you what, every dollar you make, 15% of it is going to be tax-free. Now, one thing I'll point out about the intangible drilling cost deductions and a lot of other investments, you have to be active in the business. But in the passive loss rules in oil and gas, there's an exemption to that. So you don't have to actively be involved in the investment, but you do have to invest either as an individual or proprietorship. You can't come in as a limited partner or an LLC and still get the same tax deductions. And that's why we carry insurance that covers all of our non-operators, and we can go in that in a little bit. And then, of course, we have our cost depreciation, depreciating our surface equipment. So we can write that off. And then lastly, we have lease costs, because whenever we drill a well, in addition to the cost of drilling the well, we have a certain amount of lease costs. So let's look at actually an investor's return, and let's look at his tax advantages and how this works. So I'm going to show you one of our funds that we did. This particular fund we did right when COVID hit. So, there wasn't a lot of people interested in investing in oil and gas at that time, but we're going to run through the tax incentives and exactly how this worked for one of our partners. So again, we want to mitigate risk. In our funds, we have multiple wells, right? Because if you're only in a partnership that you have 1 or 2 wells, there's always a chance that you could have a mechanical issue, or you can have some type of issue that the wells don't produce as much as you anticipate. So if you spread your interest out over a number of wells, obviously you're diversifying your risk, which is what we did here. This fund had 28 wells in it. Let's look at our cash flow. Now, you'll notice up in the upper left-hand corner, this is actually cash on cash. So our first distribution in this fund was July of 2020. I don't know if y'all remember what oil prices were in July of 2020, but they were about $14 a barrel. For the whole year 2020, oil prices only averaged $39 a barrel. So our operational cost, our lifting cost, is another important thing when you look at when you're evaluating an oil and gas project. The good thing about a lot of these shale plays is that they don't produce a lot of water, okay, because that's very important. You have basically the same as you do in a multifamily project. You've got your electricity cost, but in addition to that, your basically maintenance costs, and then of course you have in a lot of oil and gas wells water costs. So you want to make sure you're in an area that doesn't produce a lot of water. And but as you can see from these distributions, this particular fund here, we have made 50 months of distributions. The investor, he put in $100,000 so far, cash on cash. He's gotten $92,255 back. And if we hadn't had the low prices, he would have already paid out on a cash on cash basis. But his average monthly distribution was $1,845. Let's look at the tax situation. And this particular investor, As you can see, obviously this is the K1, and I'm not going to run through every K1, but again on line 13, that is our intangible drilling cost deductions. On line 20 is our depreciation. So we did get some write-offs in 2019 because of some of the wells started drilling prior to the end of the year. So this investor, he put in $100,000. He actually was able to write off $16,728 in that year. We didn't have any income in 2019 because we were drilling wells. And usually when you're drilling these types of wells, it takes you only about 45 days to drill the well. But by the time you move your drilling rig off, you move your completion rig on, you're looking at 4 or 5 months. So what I tell a lot of people, that first year, you're not going to generate a lot of cash flow, but you are going to have cash flow. In year 2020, we got the majority of our intangible drilling cost deductions. So he wrote off $41,692 in intangible drilling cost deductions. And then in year 2021, he got the remainder. So at this point, we automatically convert everybody to a limited partner because obviously we've taken all of the tax deductions at that point, and so now we want to make the conversion. And then, of course, I'll run through and kind of go to a synopsis here. So when we look at it over the years, our intangible drilling cost deduction, he wrote off $20,000 in 2019. He wrote off $45,000 in 2020. He wrote off $5,000 in 2021, which is total intangible drilling cost deduction was $71,338. Now we have our lease costs, because since he invested in this particular program, he had about $8,500 in lease costs, which was the cost to go out and lease the leases. This is not intangible or intangible, but we can use our depletion method, which in this case we use cost basis depletion in order to take another $8,400 in deductions. So when you add those two numbers together, the $71,000 plus the $8,475, he actually wrote off $79,613 of the investment over that 2.5-year period. And now when we look at our excess basis depletion, we had an additional $17,092 of tax-free income because of the depletion allowance. So now let's look back at our investor's investment. He invested $100,000. He wrote off 79.61% in IDC deductions. He's in a 37.5% tax bracket. So his estimated tax savings was $29,853. So our after-tax investment, he invested $100,000. He reduced his investment by his tax savings of $29,853. So his after-tax investment was $70,147. And I'd like to point out that this fund actually returned $70,842 in just the first 26 months, even with the low prices during COVID. So that's what the value, that's how the taxes work. That's how we work with a lot of CPAs around the country. We work with registered investment advisors, and a lot of those individuals, they use oil and gas in order to offset their clients' income. So just to recap, as of August of 2024, the fund distributed $92,255. The tax savings included, it brings it to a total of $122,108 if you include the tax savings on it. So our funds, our drilling funds, we want to hold those funds for 3 to 5 years. And basically, some of them will hold longer, depending on, what prices are. But we feel in these horizontal wells, we know in these horizontal wells that we're going to get over 50 to 60% of the production back in that first 3 to 5, 6 years, somewhere in that time frame. And that's where we're always looking for opportunities to sell at that point. So just to show you some of our partnerships that we've done, the Archer partnership was the first partnership we did under this format. We raised $1,390,000. We kept the fund for 72 months. We distributed monthly revenue on it. The investors averaged 19.90% annualized cash flow, and when we sold, the total return was 1.87 to 1. Our 2019 fund, we've been in this fund now for 60 months. Again, it was a fund that got hampered by COVID. Half of its wells didn't even go online until 2022. But anyway, we put 2.7 in this fund. To date, we've gotten back $2,167,000. If you include the tax incentives, the investors have already been paid out. But our goal will hold this fund probably for another year and then sell it. And then our Income and Development Fund 1 was the fund we did during COVID that we were just talking about. We put in $1 million. We've gotten back $989 in actual cash flow. We've been in it for 50 months. And of course, after the tax incentives, the investors have already recouped their money on this fund as well. And then of course, you can see our other funds, I mean, they're newer funds, so they're really just starting to get started. So the way these funds work is that basically you put, that first year, as I said, there's not a tremendous amount of cash flow on it, but as the wells come online, they start producing. So tomorrow, I'm going to be giving a talk where we're actually going to dive into the different funds and what the returns are, and and exactly what we do. But we also, in addition to doing drilling funds, we have oil and gas mineral funds, where that puts the investor in the position of a landowner. So, when you're buying minerals, you're buying part of the landowner's interest. There's not really a lot of tax deductions, IDC deductions on buying minerals. It's more of a long-term hold. But the key to buying minerals is that you have to be in an area where there's going to be multiple wells drilled, and you got to have multiple layers in the cake in order to make a nice return. But we've done about 60 1031 tax-free exchanges, where people coming out of real estate into oil and gas minerals. We've had people that invest in IRAs and stuff, and it's a great long-term investment that throws off cash flow. So with that, I'll be happy to answer questions. We've got about 10 or 12 minutes left if anybody has any. Yes, sir.
Is there another bite at the apple when you sell the drilling?
Yeah, in fact, I didn't, that's not really included in our estimated return. So in these newer shale plays, remember I said you've got a 1,280-acre drilling unit. So on that 1,280-acre drilling unit, there's going to be 2 to 4 wells drilled on that unit. So when the first well is drilled, the SEC, they give you, that is identified as an exploratory well, even though it's in a development area. But once that well is drilled, the SEC will give you the well location to the east, the one to the west, the one to the north, and the one to the south, all become what they call proved undeveloped locations. That means that you have proved up the reserves under that 1,280 acres. So when you go to sell, you get, in addition to just getting a multiple on your cash flow, you also, in a play where you have upside development, you're going to get an additional monies for the unproven reserves. And usually those will be on a PV30, somewhere in that range. So if you got 1 million barrels of oil, they'll discount it by about 30%, and they'll pay you for the value of those reserves. So I'm glad you brought that up. That was pretty important. Any other questions? Yes, sir.
So while you're a normal partner, it's in your name. And you said once the tax benefits are done, you swap out to an LP. At that point, would you like maybe switch it up to an LLC as being the LP?
Yeah, you could, but at that point you're a limited partner anyway. I mean, so being a limited partner versus a general partner. So in our programs, you can either be a general or a limited, and you get the same tax deductions whether you're a limited partner or a general partner. The difference is, being a general partner, you can take it against any form of income. You can take it against state taxes. I mean, people that live in California and New York, you can write those write-offs. But as a limited partner, and about 95% of our investors are general partners, but as a limited partner, you still get those same deductions. You can only take it against passive income at that point. But yes, we do convert everyone to a limited partner once we've taken the deductions. Yes, sir.
That put in $100,000, they were returned all their capital on month 26?
Including the tax incentives.
Correct.
Right.
And then To this gentleman's question, when you exited that, was there an additional payout?
Well, we don't want to exit in 26 months. I mean, obviously, we want to hold the funds and continue to generate income.
Sorry, maybe I didn't explain that correctly. I thought in that example, you guys had already packaged that well up or that fund and then sold it off. I'm wrong there?
Well, our goal is to hold the funds until we get about 50 to 60% of the reserves under the ground and then sell them. I mean, we don't want to sell them just as soon as we reach payout. I mean, the bottom line is, I mean, we're generating good cash flow. The life of these wells are 20 to 40 years. So, you know, and the reason why we can sell when in that 70 months is because we still have quite a few reserves left. And there's a lot of people out there that pay for cash flow. Our goal is looking at the most optimistic point of where we want to divest at.
Okay. Yesterday I was talking to Paul, I think he's your president. He had mentioned that, and again, I could be wrong. I've only been looking in these things for like a year and a half, but he had mentioned that around year 5 or 6, you guys will opt to sell and move on, almost like a commercial, like an apartment building or something.
Yeah, that's correct. I mean, as you saw in our first fund that we did, we sold it in 72 months. You know, as far as on that. So we're just, you know, some programs we have own more acreage, so they kind of got a different exit strategy than the drilling programs. And so, yeah, but our goal on our drilling programs is to sell in that 5 to 6 years.
Okay. Sorry, I'm slow, but at that 5 to 6 years, when you do sell, is there another payout at the end there?
Yes. Yeah.
And for that example, what did that look like? Or you guys haven't exited that one yet?
If I can get back to so when we're generating monthly income, as you saw on the first fund, when we did that, we've already generated about $92,000 worth of income in the first 50 months. And the fund is still throwing off income, you know, at that point. So when we go to sell, usually what a buyer is looking for, and there's you know, they trade oil and gas interests all the time. There's plenty of buyers out there that like to buy cash flow. So usually we can sell it somewhere up on a multiple of that cash flow. Maybe it's 48 months of cash flow. But in addition to that, you know, we have the upside on the acreage cost. So, you know, in these types of funds, I mean, obviously, we're not out here trying to hit home runs. We're not taking a lot of risks. I mean, basically, we're just going in and we're drilling wells and we're looking to get that 2 to 2.5 to 1 return on our money back. And on the Archer fund, we ended up getting 1.87 back on that particular fund. Even though we sold it in 6 years, there was quite a bit of life left in the fund. But we just thought it was an opportune time to sell at that point because obviously we can make our investors a nice return on their investment.
Okay, understood. Thank you.
You know, oil and gas wells are like houses, right? The older they get, the more they cost. You know, you have workovers, anything like that. So, you know, you don't want to sit in them for 20 or 30 years. I mean, it's nice to have, you know, what little income you have after 10, 15 years down the road. But as I said, you start having a lot of operation issues and stuff like that. And as your production comes down, you know, the key, but what I always say for a retail investor, what you look for is obviously you want to be in wells that you're going to get your money back as quick as possible. And I think that's what the horizontal wells offer. Simply because you're getting these high flow rates in the early years of these wells. You know, you see about a 35% decline rate in the first year. But because you're opening up that much rock and you're fracking these wells, if you've got $70 a barrel and a well makes 100,000 barrels of oil in the first 75 days of production, I mean, you've gotten over $7 million worth of gross revenue. And, but, you know, just the way that the wells produce, and if you're in the right area, you know, I think we can recoup our money pretty fast. Now, the reason why you don't see, if we were in one well, you know, maybe it pays out in 90 days, but we're in 28 or 30 wells, and they don't all get drilled at the same time. So that's why the payout is, you know, longer over that, because you have wells coming online continuously throughout that first year to year and a half. Yes.
I've got one over here, Mike.
Go ahead.
Mike, when you acquire a project, what sort of acquisition fee do you charge, or do you mark up the project by the time you sell it to the retail investor?
So the way our funds work, they're pretty simple. I mean, there's a one-time fee on the front end of 15%. It's a 90-10 split. The investors get 90%, we get 10%. We put up 3% we buy 3% of the units alongside the investors. And when we sell, there are no other waterfalls. I mean, it's just basically a 90-10 split. So the investors end up with 90, we end up with 10. And then when we buy leases, like if we buy a lease and we pay $3,000 for it, we don't mark it up and sell it to the partnership. Basically, whatever we buy it for is what we sell it to the partnerships for.
Yes, Mike, where are you drilling? Where are you looking?
So our areas that we focus on, we've participated in over 1,000 wells up in the Bakken in North Dakota. And in this Cherokee Shale play, which actually started in 2020, we've probably got 7,000 or 8,000 acres leased in it now that we've participated, I don't know, probably 30, 40 wells so far. We're going to spend, probably this year, we will spend about $24 million in the play, so we'll probably be in well over 100, 150 wells. I mean, we've got quite a few wells that are drilling now. We take small interest in our funds. I mean, obviously, as I was saying, these wells are, $10 million a piece, so we're not going out there and drilling one well. I mean, we're spreading our risk over a number of wells.
Thanks for the presentation today. I'm curious about your financial assumptions in terms of what price per barrel that you're using in your models, and from a stress test perspective, we're looking at 70, 80, but we've seen 40, we've seen 20.
Well, when horizontal wells, in the early days when you're drilling horizontals, you're putting in not only sand, your sand is basically your propping agent, and then you put it in with water, probably 95, 96% water. The other 4% is surfactant. So, and in the early days on a horizontal well, most wells are going to flow, right? But you do have water disposal cost. So in the early days, your lifting cost, what it costs us to produce a barrel of oil, is probably $30 to $35 a barrel. But as you get that water back from the frack that you've put in the well, then your lifting cost drops to about $25, $26 a barrel. So like I said, with these wells, there's not a lot of water. It's mostly oil and gas. And so you don't have a lot of disposal cost. The wells flow for the first year, probably, before you have to put a pump jack on them, so you don't have any electricity cost. And so they're pretty maintenance-free in the early years.
Do you utilize hedging, the commodities market, to hedge the future sales price and lock it in, like at 70 or 80, or do you just use
We
cash
can
basis?
hedge. We have hedged. You can buy a floor on prices, but the outer years is what you need to look at if you're buying floors, right? I mean, I can go out there and, we've done costless collars in the past where, you've got a floor and then you have a ceiling. And so you can lock in a floor. I don't think there's no reason to do it now. I mean, obviously, prices are pretty stable. The only way they're going to go is probably up if the war escalates overseas or the wrong administration stays in office. Prices are going to go up. I mean, the bottom line. We can have all the green energy you want. The reason why we've got such high electrical prices right now is because, they've subsidized all this green energy. But in the recent days, you've seen Shale now, they're moving away from it. A lot of the bigger companies are saying we just can't make our shareholders any money on all this green stuff, so we're going back to producing oil and gas and petrochemicals is how we make our clients money. So you're starting to see that transfer back now. Just people are starting to come back into the areas.
Thank you.
I think I'm out of time.
Thanks.
This podcast is a presentation of Rich Dad Media Network.